As the Federal Reserve navigates the intricate process of revising bank capital requirements, a delicate balance is being struck between regulatory prudence and industry collaboration. This high-stakes endeavor, a decade in the making, has the potential to reshape the financial landscape and fortify the system's resilience in the face of future crises. At the heart of this undertaking is Jerome Powell, the Federal Reserve Chair, who finds himself at the intersection of competing interests and conflicting perspectives. On one side, there are those who view his recent overtures to major bank CEOs as a concerning capitulation to industry pressures. Critics like Jeremy Kress, a former Fed attorney, have voiced apprehensions, warning against the dangers of bending too far to the will of banks. Yet, others, such as Thomas Hoenig, a former Federal Reserve Bank president, argue that Powell's approach is grounded in statutory requirements and a genuine pursuit of well-informed policymaking. They contend that seeking input from the industry is not a mere exercise in consensus building but rather a necessary step in crafting regulations that achieve their intended outcomes. The stakes are undeniably high. The initial draft proposal, released last summer by the Federal Reserve, the Federal Deposit Insurance Corporation, FDIC, and the Office of the Comptroller of the Currency, OCC, called for a 16% increase in the capital cushion that banks must maintain. This measure, aimed at fortifying the financial system against potential shocks, faced fierce opposition from an industry gearing up for a potential legal battle. In a recent closed-door meeting with some of the most influential bank CEOs, including Jamie Dimon of JP Chase and Jane Fraser of Citigroup, Powell extended an olive branch. He assured attendees that the public would have the opportunity to weigh in on key changes to the proposal, a move that could be seen as a conciliatory gesture or a pragmatic attempt to preempt legal challenges. However, the path ahead is far from straightforward. The Fed's subsequent proposal of a dramatically weaker version of the capital overhaul to other regulators has raised eyebrows and sparked concerns about potential regulatory fragmentation. Some worry that the Fed's board, long celebrated for its consensus-driven approach, may be yielding too much ground in pursuit of industry support. Powell's assurances to lawmakers that there has been no final decision on changes, coupled with his acknowledgement of quite a bit of progress, only add to the intrigue. Whispers of potential unilateral action by the Fed, should the three regulators fail to align, have further heightened the stakes. At the heart of this intricate dance lies a fundamental question. Can Powell strike the right balance between regulatory rigor and industry collaboration? Can he navigate the often conflicting demands of safeguarding financial stability while also fostering a productive dialogue with the very institutions he seeks to regulate? As the process unfolds, all eyes will be on the Fed's next moves. Will the public comment period yield substantive revisions, or will the initial proposal be watered down in the name of consensus? How will the Fed reconcile the divergent perspectives of its fellow regulators, the FDIC and OCC, whose officials have hinted at resistance to any capital increase deemed too lenient? The challenges are multifaceted, and the implications far-reaching. On one hand, a strong capital regime could serve as a bulwark against future financial crises, protecting the broader economy from the ripple effects of systemic shocks. On the other, an overly burdensome framework could hamper the industry's ability to extend credit and fuel economic growth. In this high-stakes game of regulatory chess, Powell finds himself in a precarious position. He must navigate the intricate web of interests, balancing the need for a resilient financial system with the imperative of fostering a vibrant and competitive banking sector. His ability to forge consensus, while upholding the Fed's mandate of safeguarding financial stability, will be put to the test. As the debate rages on, one thing is clear. The outcome of this process will have profound implications for the financial landscape and the broader economy. Whether Powell can thread the needle, forging a path that satisfies both regulators and industry stakeholders, remains to be seen. In the end, the true measure of success will lie not in the optics of consensus but in the robustness of the final rule. Only time will tell if Powell's delicate balancing act has yielded a regulatory framework that can withstand the test of time and the inevitable shocks that lie ahead.